Okay, so there we go. Like I said, welcome everyone. Today we're going to be talking about advanced technical analysis. So I want to give you guys two disclaimers, which is with the first one being, okay, so before we get started, we're going to talk about the market maker ideology once again, just to give you guys a deeper understanding and perspective in regards to that. Just want to adjust my, okay, there we go. So we're going to talk about the market maker ideology. We're going to go a little bit more deeper into that, just to give you more perspective on that. And then also we're going to talk about multi-time frame analysis and how to use different time frames to your advantage and also. So I want to give you guys two disclaimers, which is with the first one being, okay, so before we get started, we're going to talk about the market maker ideology once again, just to give you guys a deeper understanding and perspective in regards to that. Just want to adjust my, okay, there we go. So we're going to talk about the market maker ideology. We're going to go a little bit more deeper into that, just to give you more perspective on that. And then also we're going to talk about multi-time frame analysis and how to use different time frames to your advantage, and also kind of give you guys a perspective on how all of this and how the market is fractal. Then pattern recognition, meaning pattern recognition in the sense of the manipulation. As you guys know, there's a certain way I perceive the market. This whole trading alchemy will be based around that. This is why day 1 to 4 is very, very important, and you have to watch that. Then last but not least, we're also going to touch on premium and discount. So first things first, disclaimer, as you guys know, trading involves risk. I am doing this in partnership with Volt Markets. All the views shared in this recording basically is purely views from myself, and yeah, not Volt, obviously. And Volt is purely the liquidity provider that I use and the broker that I use. And obviously, in order for Volt to grow, we need to put the right information out there, but also making it clear that you guys are all adults and we all can make our own responsible trading decisions. And then the second disclaimer I want to give is, guys, like I said, I have been moving, so it's been very hard for me to actually work from home. Setting up the PC, I still haven't been able to set up my PC fully, and I'm still waiting for my Wi-Fi to be installed. So I'm not, I wouldn't say I'm not prepared. I'm not fully prepared as I would like to be. However, the knowledge is still there as always. So no stress in regards to that. So let's just quickly confirm with everything. If you guys can hear me, just drop a 1 in the chat. If you guys can see my screen, drop a 2 in the chat. You guys should be able to see the definition of the market maker ideology. Okay, Chris is on it there. Awesome. Before we get started, welcome Adrian, welcome Christopher, Dwayne, Eddie, Simbulala, Unati, and Vince. Like I said, any other individuals who join in, we will welcome them as time goes on. So first things first, let's talk about the market making ideology as well once again and go a little bit more deeper into it. So what is the definition of the market maker method or ideology, which I always talk about? Now, the market maker ideology refers to the set of approaches and strategies adopted by market makers in the financial markets. Emphasis on that again. The market maker ideology. Remember, ideology falls in line with beliefs, perceptions. So the market maker ideology refers to a set of approaches and strategies adopted by these market makers, meaning there's no one holy grail. There's multiple ways that they actually go about their business. And it's very crucial for you as a trader to be able to spot all of this, to be able to adapt to the market. Doesn't matter what condition the market is in. So market makers are specialized entities or individuals who facilitate trading by providing continuous bid and ask prices for financial instruments. So as you guys know, bid and ask prices is basically what forms your spread. And whenever you enter a trade, you are always in a loss. That spread basically is the cost of doing business. To go a bit further on that, basically, if you want to start a brokerage and you go to, let's say, MetaQuotes, and you find a liquidity provider, they will obviously give you a spread. Now, how the broker makes money spread is that they add onto that spread, meaning 0.2, 0.3, 4 pips, that allows them to actually make money on that. So if you guys would have noticed, let's say trading a 0.01 lot size, whenever you enter trade, you're always down 8 cents, 10 cents. That's the cost of doing business. Now, Market makers always stand ready to buy from sellers or to sell to buyers at quoted prices, thereby ensuring liquidity and facilitating efficient price discovery. Goes back to that thing, you and I can't move the market by ourselves. The market maker has the power to do that. So, what is the role of market makers in providing liquidity? So market makers are responsible for maintaining the liquidity in the market by offering continuous bid and ask prices, like we just said. They facilitate the buying and selling of financial instruments by providing a platform for market participants to execute their trades. Very interesting as well. So as you guys just heard, they also provide you with a platform to actually execute your trades. It goes back to this thing of how we are limited as traders. And this is why we have to use the resources available to us, meaning the broker, the platform, making sure the broker is licensed, making sure the platform you use is legit, it's fast, and also that it is high speed. Obviously it's fast, which is high speed. So there's a lot of things to consider in the sense of that not any individual can just start the brokerage, for instance, and just start the platform and even start trading with him. It's a massive process. It takes money, and this is why trading is one of the most liquid industries in the world. So by offering liquidity, market makers help reduce transactional costs, narrow bid and ask prices, and ensure that trades are executed promptly. Emphasis on the narrow bid and ask prices. This is why the market is what I say, quote unquote, manipulated. Because why would you as a businessman intentionally narrow your potential profit unless there's another way you can potentially benefit from it, right? Okay. So significance of market makers in market operations. So the market makers play a crucial role in maintaining orderly markets and ensuring smooth trading operations. Without market makers, markets could become illiquid, making it challenging for traders to execute orders at desired prices. So let's talk about this again quickly. Look, what is liquidity? Liquidity refers to basically no stress all. So Jev, okay, Chris, I can send you the link. Not a problem at all. There's the link in the chat. So yeah, like I said, so let's talk about liquidity quickly. Liquidity refers to basically whenever there's a buyer, there's a seller on the other side. So what happens? If you take a position, the market maker takes the opposite side of your position, or the broker takes the opposite side of your position, right? We can all agree on that. We've all seen that. We've all heard that. So what happens if there is no market maker or there's no one on the other side? This is what would make the market illiquid, because now what happens is it's always a side of a thing where there's always buyers and sellers matched, right? Now, let's say, for instance, you enter a trade, right? You would, let's say, buy one lot, but there's no seller on the other side to sell that one lot to you. What happens then is the market maker or the broker must take the other side of your position. So let's say, for instance, there's no one on the other side, you enter your position. What will happen, as you guys know, with the trader, if you place a trade, your order goes in immediately, right? But let's say sometimes you would see it's rejected, trade disabled, whatever the case, that's errors you get. Now, what happens is that you always have that little loading screen. Now, if there's no liquidity on the other side, what will happen is once you press a buy button or your sell button and there's no one on the other side, your order will stay loading in the market and you won't get entered at that price. And only once you get matched with the opposing party, that orders will match, and then only your order will go through. So this is why, like, the market makers have massive liquidity, so they can always take the other side of your position. I hope that makes sense. And also, like I said, market makers play a crucial role in maintaining orderly markets and ensuring that ensuring smooth trading operations. So what do I mean by maintaining orderly markets? This is to make sure that there's no market crashes, to make sure that they can spot, basically, like, study data to make sure that we can avoid recessions based on what we trade. This is why you would, for instance, see that, let's say you want to trade the Turkish lira. Market's just been going to the upside. So how do you manage that, for instance, so that the Turkish lira isn't destroyed? You, for instance, add a massive spread on it so that people would be hesitant to actually trade it, and causing less liquidity, also causing less of a crash to potentially take place, right? So even though market makers manipulate the market, they also oversee the market to make sure that everything runs smoothly. And remember, because they have this massive job as well, they have to make sure they benefit out of it, right? Okay. So understanding the importance of market maker dynamics. So understanding the market maker dynamics is essential for traders as it provides insight into market behavior and price movements. Now, traders can also gain valuable information by analyzing market maker activities such as order flow, inventory management, and pricing strategies. So for instance, order flow, how do you spot that? You have to understand market structure. I've touched on it so many times. I can say it in my sleep. Uptrend, higher high, higher low, downtrend, lower low, lower high, or you consolidate. Very, very simple. And then also inventory management. Now, this is one thing we can't per se see unless you trade like stocks and so forth in a very public, like Bookmap, where you can actually see the inventory which is coming in. Remember, it's a business. So think of all the markets, all the orders coming in as stock, basically. So you always have to stock take to make sure that this is why, for instance, you would see certain options trades have expiry dates, right? So good example. So by understanding how market makers operate, traders can anticipate price movements, identify liquidity levels, and make informed trading decisions. So we've covered this many, many times. I'm not going to go too deep into that. I'm just putting emphasis on this again to make sure that you guys understand the importance of this as well. Now, this pattern over here, there's also one thing I want you guys to understand. The market is fractal. So what does it mean when we say the market is fractal? Meaning, if you remove the time frame from the chart and you look at a weekly chart and a minute chart, you shouldn't be able to tell the difference. The only way you should tell the difference is if you look at the price tab by knowing that, okay, obviously the 1 minute chart doesn't move 300 pips within a given whatever. Whereas a weekly time frame, if you look at that, maybe you'll see 300, 400, 500 pip moves. You know, so this pattern over here, basically, this little pattern that we've covered so many times is literally your cheat sheet to the market. Now, this is obviously for a sell model, and we'll also look at the buy model. But you should touch on this again. Basically, what you have is here is your Asian session. Asian session builds liquidity, a high and a low. Price then manipulates that area, in other words, accumulation. Then you have your manipulation. Then you have your distribution, basically, AMD. So this is your cheat sheet, basically. And why I say this pattern, whether it is the daily, meaning your 15-minute chart, understanding market structure with sessions, this can also be applied to your weekly outlook, meaning looking at your Monday, Tuesday, Wednesday, Thursday, and Friday. This can be applied for your monthly outlook, meaning beginning of month to end of month. This can be useful for the 3 quarters or the 4 quarters of the year, meaning Jan, Feb, March, April, May, June, July, August, September, October, November, December. So also for your quarters and also as a whole for your year, this pattern, the idea that you always have consolidation, manipulation, and distribution applies everywhere. This is why today we're talking about advanced technical analysis. Not like we're going to be teaching a different pattern or anything, but purely teaching you a different approach, as doesn't matter what you look at it. The same theory applies everywhere. Literally, think about it this way. You can either trap the market using price or using time. There's only 2 ways to trap the market. That is time and price. Time and price must always meet. Keenan, no stress that you're late, my man. As long as you're here, that's what's important. And thank you for joining. Really appreciate it. Then, like I said over here as well, this is your second cheat sheet, or your second type of pattern, where the similar thing will happen, where you will have your accumulation, your Asian range, high and low liquidity, accumulation, manipulation, and then your distribution towards the upside. So very, very simple. It's very, very important that you guys always remember this concept, so that you guys can, because the thing is, you never want to be trapped in the wrong side of the market. You always want to wait for the market maker to show you his hand, be it in the day, the week, the month, the quarter, or the year. Now, just to give you a perspective, notice the time frame here on top. This is the time frame. You can see this is the 15-minute chart. and very, very simple concept. So as you can see over here, here we have our Asian session. It's our accumulation. Here's our fake move beginning of day, setting the manipulation. And here's our fake move end of the day, which is caused by the distribution. So you will always have a similar pattern like this. So either price will then break to the downside for that fake move beginning of day and end the day pushing up and then end the day pulling back basically. Just let me know if you guys stuck anywhere, if I'm going too fast or if I have to repeat something. So this is the daily basically. Let's take it a bit further. We can see accumulation, fake move to the upside. They induce everyone long before going short, and end of the day, they have such a strong move to the downside. What happens now is price then induce everyone to sell. And what happens in the next day, you can see price then buys. Here you can see then this is for the week. You can see this is from Monday till Friday. So you can see, just keep an eye here. Here is Monday. Here's the end of the week, Friday. This is obviously the new week's open. This candle is the last candle of the week. So then basically similar thing. Notice how you have a fake move beginning of week where price will break to the downside. And as you can see also, here's your accumulation over here. Accumulation, manipulation, the fake move beginning of week, and here's just your distribution all week. And what happens then is, notice around this Friday, price breaks above this high once again, and then suddenly we just have this drop to the downside, and that is your fake move end of the week. Now, the whole idea behind this is, and why I mention it again, if we go back, what happens in the beginning of the day is price breaks above. Now, everyone's chasing the buy. Now, the buy becomes invalidated and price drops. What happens now? You a seller. And that sell basically induces everyone to sell when price pulls away. Let's take it further. We can see the beginning of the week starts. What happens now? Beginning of the week, everyone is selling. Then the sell is invalidated. And then Tuesday, Wednesday, price basically buys. So bullish. But then we have this strong move coming down on Thursday, sweeping this liquidity at this level. But then obviously we do expect midweek reversal to come through either Wednesday or Thursday. It all depends on what your structure is, whether you're bearish, bullish. Obviously, you can't just determine this based on this. There's things that must fall in line and into place for that to become valid. Then you would see that what happens is on Thursday, you have the strong move to the upside. What happens now? Friday morning, price buys again. That induces everyone to buy end of the week. So basically, beginning of week, induce everyone short, end of week, induce everyone long, snatch the market away from them before the market closes, induce everyone short based on the strong move down. Once everyone is short, basically, you trap them again, moving into the new week. And this is for a week. Now let's look at a month. So you can see as well, this is an entire month. So you can see once again, beginning of the month, price moves down, creating that fake move beginning of month. Then you can see basically price then trades towards the upside. So we also spoke about this. You can also view this as liquidity. It all goes back to perspective. So for instance, like that, you can view this over here as your accumulation. So you can see this as your here now. You can view this as your accumulation. Price makes a fake move, your manipulation, and price basically distributes buying, and there is your move to the upside. But the entire reason I'm showing this once again is because notice end of the month how price traded up basically since the 10th, 11th, made higher highs the entire month until end of the month when suddenly price basically pushed bearish. So inducement short and inducement long before snatching the market away from them once again. This is very, very important to understand in order to implement structure with other things as well. Then basically, this is the entire year. So notice, obviously in the weekly time frame, I just did the first time to basically squeeze it onto the screen. So then also we'll see over here, beginning of the year, Here you can see once again, this would be what you would call your accumulation. Price then breaks to the upside, inducing long. Fake move beginning of year. What happens then is price hovers, basically consolidates. Then suddenly end of the year, you have a move to the downside, inducing short. What happens then? Beginning of the new year, price then moves to the upside. So before we continue, what I just explained over here now, does the idea of the fake move make sense? The fake move, beginning of day, beginning of week, end of week, beginning of month, beginning of quarter, beginning of year, end of year, beginning of session, end of session. Does that make sense? If it makes sense, drop a 1 in the chat. Just drop a 1 in the chat. Okay, awesome, awesome. I have to make sure that this makes sense. Otherwise, if we move further into it, we might as well start the session all over again. So, okay, now you guys understand that. Awesome. Now let's now move into multi-time frame analysis. Now there's going to be two ways. Yeah, Christopher. So it is a bit confusing. But my advice to that will always be go and look at it yourself as well. Look at the days, look at the weeks, look at the months, look at the quarters, look at the years, and not with the idea that, oh, I want to go trade now, but purely with, okay, why did they push up at the beginning of this point here? Why did they push down here? Basically, just understanding the reasoning behind why they did certain things. Once that reasoning is understood, now we implement, like I said, order blocks, your institutional levels, your trading strategy itself, but it must fall in line with the manipulation, basically, if that makes sense. So also there will be two ways we go about this multi-time frame analysis. The first way will be actual analysis, and the second thing is basically by looking at it from this market maker perspective, a different type of analysis. So multi-time frame analysis is a powerful tool or a powerful technique used by traders to gain comprehensive view of the market trends by examining price action across different time frames simultaneously. So instead of relying solely on one time frame, traders analyze multiple time frames from shorter term intraday to long term weekly or monthly charts to obtain more holistic perspective of the market. So for instance, if you are going to be investing into something, you don't purely want to have a short-term gain on it. You want to see where price is heading long-term in order for you to actually get into that position when it starts taking place. In other words, if you understand that, for a good example, let's say for instance you have a certain analysis, let's say for gold, for instance, and you would trick. Yes. 1 o'clock, no, 2 o'clock. I can either phone him, or if he wants to wait. Sorry about that, guys. Okay, so instead of solely on one time, okay, so what did I say now? Sorry, I got distracted now, yeah. But yeah, basically the whole idea is, let's say for instance, you have analysis for gold. We know gold's a spiritual element. It's a prediction for gold that it will go to $3,600. If we look at the gold chart, we can see clearly gold is bullish. Gold is just gaining value. If we look at history itself also, we can clearly see that gold has something of value, which is more and more valuable as time goes along. So for instance, if you understand that long term you are bullish, you want to then be able to go to smaller time frames to find a perfect reversal to get into that trade and then basically benefit from it from day one up until the end. You don't just want to benefit for one day, basically. You want to benefit long term. So benefits of analyzing multiple time frames, you get a comprehensive view of the market. So by analyzing multiple time frames, traders can gain a comprehensive understanding of market dynamics, including short-term fluctuations and long-term trends. Then you also have confirmation of trends. By examining multiple time frames, it allows traders to confirm the direction of the trend across different time horizons, enhancing the confidence in the trade decision as well. So this is why, for instance, like I said now, you want to see, like we spoke about this in other sessions as well. Let's say now, for instance, you have a supply demand zone on your 4-hour and you enter from your 15-minute. You will obviously have a bearish structure come towards that zone before it flips bullish. But that pair will first flip bullish on a small time frame before it flips bullish on a big time frame. This is why it makes it so difficult for people to actually get into that trades, because it's easy to see a move after it happened. You want to get to that point, like my mentor always said, if you can't see it in hindsight, you can't see it in foresight. You want to be able to start spotting certain things way before they happen. Okay. So then also enhance accuracy. By aligning signals across different time frames, it can improve the accuracy of your trade setup by identifying confluence areas where multiple time frames agree on the same trading signal. And also improve timing. Remember, we spoke about this in the beginning. You can trap the market either in two ways: time and price. So it also helps with improved timing. So multi-time frame analysis helps to identify optimal trade entry and exit points by considering both short-term and long-term trends. So meaning if you're on an uptrend long-term and you can see a reversal happening internally, you can start projecting where the price is going to start holding, or actually start rejecting that level, whether you should close your trade or keep on holding it. So quick question from Christopher. He's asking, Jeff, would you say someone that's for Jeff, would you say that's, for example, someone, let's say, sorry, I had some OCD there, wasn't concentrating. So sorry, Chris is asking, Jeff, would you say someone that's, for example, let's say an intensive scalp trader, should you consider those higher time frames as well, or would you say it's more valid for those position traders who would look to go a certain pair for a certain time? So Christopher, two things. I don't like scalping. Why I don't like scalping is because now you target 10 pips, 10 pips, 10 pips, right? Now to catch 100 pips, you've exposed yourself to the market 10 times, emotionally and financially. Whereas if you look at your big time frame, you wait. You just simply wait. The same amount of time it will take you to catch those 10 trades, those 10 pips, most likely will take you the same amount of time to catch 100 pips in one trade. Now, here's the other thing. If you go look at those bigger time frames and you actually wait for your setup, instead of exposing yourself to the market financially and emotionally 10 times for 10 pips, expose yourself once for 100 pips. Does make sense? And the other thing is also with scalping, people who scalp are so focused on only the small time frame that if something happens against them, they don't understand why it happened. But that's because they don't understand market structure. So I would always say it doesn't matter if you're a scalper, intraday trader, investor, whatever you want to identify yourself as a trader. I don't want to say that information I have is everything, but I feel like if you're not equipped with this information and something happens, you won't be able to determine why it went wrong. And you won't be able to also go fix that problem as to why it went wrong, because there will always be that unknown factor as to like, why did the market move the way it moved? This is why I say, if you go study the fake moves, you have an understanding of why it happens. So if you hit a stop loss, for instance, it's not like, oh, what happened? You can determine if you go back, like, okay, I was on the other side, I entered early, I didn't wait for a pattern, I didn't give the market maker enough time to actually work the move. You'll actually be able to start getting a perspective in that regard. So Vince, I don't trade key levels. The only levels I use is institutional levels, because my problem also with key levels are basically, if you're going to be basing your support or resistance from a high or low close of a 4-hour body, now you go to your daily time frame. Now you have a body of a daily that goes through that level. How do you actually sit it in? So I would say, like, if you want to, obviously, if you trade key levels, there's a certain rule you follow with that. But my point is, like, let's say, for instance, let me draw it out. Let's say, for instance, this is your 4-hour candle, right? And you draw yourself a resistance level over here. Now, okay, that's a key level now that you've identified. Now, let's say within that day, price had some more movement. Now, okay, there is now obviously something over here, just below this level. Now, imagine now your daily time frame. Okay, I actually made a mistake there now. Let me do this. Now, imagine your daily time frame closes like this that day, but now you've marked out a 4-hour level like that. What about this day? What about this high of this day over here? And what about this low of this day over here? You understand my point? So this is why I also say, like, when it comes to certain strategies, I feel like it's been finessed. This is why I say institutional levels, half round number, quarter round number. That's the only key levels I would use. Then let's move a bit further. So then aligning signals across different time frames. First things first, you have to identify the trend. Start by identifying the trend, the primary trend on the higher time frames, such as the daily or the weekly chart. Sorry, to establish the overall market direction. Then drill it down. Once the primary trend has been identified, drill down to lower time frames, such as the hourly 15-minute chart, to look for trading opportunities that align with the direction of the primary trend. Then also, once you drill down, you can't just enter a position either. You have to wait for confirmation. Look for confirmation signals across multiple time frames, such as price patterns. Oh no, price patterns, trend lines, indicators, the market maker ideology, everything that I've taught basically so far in this trading alchemy. Your sessions, institutional levels, your candle types, supply and demand. We spoke about a lot of things. All these things have to come together, or at least majority of the concepts that I've taught basically must come together for it to validate certain part or certain sections of your strategy. Otherwise, if you're purely going to be taking it from one simple thing, I'm not saying it won't work, but the fact that it's not, so I see it like this, right? Let's say you have a key level. Let's make an example of this. Let's say you have a key level. You know that your price might react at that level, but there's a wall there now. What I want to see is multiple layers of a wall there. For instance, a key level, I want to see a supply and demand zone. I want to see institutional level. I want to see them line up with the high and low of the day. I want to see like that wall be solid using 3 or 4 confluences. And I know I can base my trade based off 3 points of historical data. Vince, would I skip from the daily time frame straight to the 5-minute? If not, why not? Because if you go straight to the 5-minute, you're gonna miss out on other important data. That is the only way I can describe it. You can't immediately go from a weekly time frame to a 1-minute time frame. It's gonna be you're gonna have massive zones, and then to refine that will be much more difficult either. This is why I say don't overcomplicate your trading. Start off with a base. Myself, I start off my week on a Monday. I analyze top down, weekly time frame, daily time frame, 4-hour. Then I know from Tuesday, Wednesday, Thursday, Friday, I only work from my 4-hour, 15-minute into my 1-minute, 3-minute for my entries. Because Monday, I've set my strongest levels based on my higher time frames. Now that I have my trend, all I have to then see is basically the market maker show me his hand, beginning of the week, this fake move. That must then line up with my supply and demands, and I marked out my weekly time frame. Once they bounce into that, I go to my 15-minute chart and look at my daily structure. Once that aligns, I then start looking for my entry. So it's literally a confluence of things that must come together before taking a trade. Then also a confirmation, like I said, aligning signals from different time frames. Confirmation, look for confirmation signals across multiple time frames. Okay, we just covered that. So then also risk management, set stop loss and take profit levels based on analysis of multiple time frames, considering both and short-term fluctuations and uptrend and long-term trend directions. Here's the other thing. So for instance, if you start doing your analysis on, let's say, your daily or your weekly, you're going to have a massive stop loss. So how do you minimize that? The only way to do it is to go back to a smaller time frame, so that instead of your zone being 50 pips, it becomes 10 pips, for instance. That extra 40 pips you might be in drawdown might now become potential profit. You see right there how you can flip a risk to reward, because let's say you trade a 1-to-1, 50 pips, 50 pips, right? Now you refine the level to 10 pips. Now that 40 pips extra takes your trade from a 1-to-1 to a 1-to-9. Just from making one simple refinement. And remember also the scale of profitability. You need you need, I think, a 40% win rate with a 1 to 3 risk to reward ratio to be profitable. So imagine if you can refine your trades all the way down all the time to a risk reward of like 1 to 4, 1 to 5 the entire time instead of a 1 to 2, 1 to 1. You want to get to that point where eliminate the fear of missing out. I know it's human nature, but remember, you are responsible for the way you feel as well. Because remember, everything happening in your mind, you have convinced yourself that it's good or not. So FOMO even is you convincing yourself whether it's a good or bad reason for you to do something. Understand my point? So be very, very careful and be mindful of what your mind dwells upon. So then advanced chart patterns. So basically this goes back to what we can discuss today, being the quarters theory. So advanced chart patterns go beyond basic formations, and they provide us with a deeper insight into market dynamics. So these patterns are based on complex market structures, and they can offer valuable trading opportunities for those who can recognize them. Emphasis on that. There are various other ways to also look at the market structure, such as the quarter theory and the weekly structure. Now, I'll see if I put the weekly structure in here because I see we kind of are against time, and there is someone in the office also waiting for me. So the quarters theory. The quarters theory is a concept in technical analysis that focuses on identifying significant market movements occurring with specific quarterly periods. It emphasizes the importance of understanding seasonal trends and market cycles to anticipate potential shifts in market direction. So the first thing is you have seasonal trends. The quarter theory recognizes that the quarter theory recognizes that certain market movements tend to occur at specific times of the year due to seasonal factors such as holidays, economic cycles, or corporate earning seasons. Ever heard of companies releasing their quarterly earnings? There's a reason why I do it every quarter. So market cycles. Traders can also analyze historical data to identify recurring patterns and cycles in the market, in market behavior. By understanding these cycles, you can also then anticipate potential turning points and trend reversals, which lines up with these levels. So what is the quarter theory? Very simple. There's 4 months in a year. Sorry, there's 12 months in a year, not 4. There's 4 quarters in a year. So 4 divided by 3, 4 divided by 12 is 3. That means your first 3 months, second 3 months, next 3 months, and the last 3 months. Sorry, my bad, man. So those 4 quarters basically gives you 3 months each. So automatically by doing that, by looking at a whole year, you can now track the market every 3 months. Doesn't that really sound much more easier? Then if you go study the weekly structure, now you can break each month down weekly. This is why we also have the day structure, break down the week daily. Break down the week in sessions. Do you see this puzzle? There's literally a thing where you must trap the market period by period, time by time, because nothing just happens like this. It is literally, I always see the market as a concert. And each pair will have their time to perform. And during this performance, it will set sights on certain things. And also, let me put it this way, this performance as well will indicate to you what future performances might look like. I hope that makes sense. But yeah, so basically, as you can see over here, the first line over here indicates January up until March. So the beginning of April is the new quarter. So you'll see basically over here, we have 1, 2, oh no. 1, 2, 3, and 4 quarters in the year. And same concept. Notice this, beginning of the year, our price push to the upside. What did it form? Liquidity. And then suddenly you had a push to the downside where you induce everyone to go long beginning of the year. You suddenly sell all year, basically. You induce people to go short the last quarter. You create a fake move by pulling price away from everyone. You can take it even further, for instance, with the quarters theory, and still look at it from this perspective. How you have a fake move beginning of quarter, then price starts trading towards the downside. Then notice this towards the end of the quarter, our price movement makes a fake move, inducing long, and then drops. Once again over here, so also there's a thing. It might look confusing at times, but this is why I say very, very important for you to go study this and actually see the market play out over and over and over again. So for instance, over here, you would see the market also just straight on dropped, basically. Now remember, you also want to look at it, long term as well. So what happened actually is beginning of the year, accumulation, manipulation, this is your distribution. All of this is distribution. So the moment you actually, once again, you wanna see price reverse, basically. For instance, only over here, you will see price form the higher high, pullback, and what you have, we discussed this, here's your demand. So this is how you should start spotting these reversals and things. It's literally a matter of, how can I put it? Being equipped with all this information. You're not going to implement everything every single day. For instance, the quarter theory, this, for instance, you would implement once every 3 months. You maybe just look over it once end of the month, just to make sure that everything is still lining up and just to refine and do some chart hygiene, basically. But that is the whole idea behind the quarter theory, is by setting the market up literally in quarters of the year. Chris, no, so quarter is every 3 months. Sorry, yeah. So every 4. Okay, let me put it this way: a quarter is 3 months. So your every fourth month, a new quarter starts. I'm not sure if that's what you meant, but if it is, then yes. So then also, I want to also talk about premium and discount and what does it mean. So premium and discount refers to the relationship between current market prices and between the current market price of an instrument and also its intrinsic value or fair market value. So a premium occurs when the market price is higher than the intrinsic value, meaning in premium, you want to see sales. It indicates overvaluation, while the discount in the market price is lower than intrinsic value, indicating bias, indicating under evaluation. So that is basically very, very simple. It's nothing too deep. To go deeper into it, traders can then leverage premium and discount levels to anticipate market reversals and trend continuations. So, and also reversal signals is when an asset reaches a significant premium or discount level, and that level mustn't obviously line up with the supply and demand zone. It may signal a reversal in the prevailing trend. Traders can also look for confirmation from other technical indicators or chart patterns to enter those trades, basically. Then also, obviously, by looking deeper into it, you can also see your continuation. So in some cases, premium or discount levels act as confirmation signals for trend continuations as well. For example, if a stock consistently trades at a premium during an uptrend, it may indicate strong bullish momentum and support further price appreciation, right? So just to give you a perspective on how you do that. Yeah, you see like that. This is what I meant. My other slides, I don't know why it didn't want to save. This goes until 24, basically. But yes, let's quickly now go look at actual charts and also see how we actually implement this into a market. So the first thing I would do, so very nice. I hit a TP now on oil. And that is very beautiful. And I actually wanted to show you guys something here as well. But I can't remember exactly what it was. Okay, so TP was hit. So basically what happens is in the premium and discount, let's say for instance that this is your trend and price forms a high, a low, higher high, higher low, higher high, higher low, higher high. In an uptrend, what do we always talk about? You buy low and sell high, all right? Now, in a case like this where price is moving bullish, how do you know when you can start buying low? Simple, you measure your high and your low, and you find your equilibrium, your 50%. Once you have your 50% marked out, now remember, everything above becomes your premium. and anything below becomes your discount. So if you're on an uptrend, for instance, you never want to buy in a premium price. You always want to sell, you always want to buy in a discount. And it can be viewed multiple ways, Vince. It can be your swing high, your swing low. It can even be your internal structure. It can even be your internal structure. So for instance, if price had a break of structure, forming a higher high, even that could indicate your equilibrium. So for instance, your equilibrium would be over here. Then if you have a break of structure, for instance, like over here, let's say this is your break of structure. It must leave you with a demand zone, for instance. That demand will only become valid if you are in a discount. Right? If it's in the premium, even if it runs without you, you don't want to buy it. Because now what happens is now you want to go buy in a premium. Now you have this massive stop loss. Whereas if you just were patient, wait for price to trade down to your level, instead of having a 1 to 1.9, you can easily flip your risk reward to having a 1.7 risk reward ratio. So that is the whole idea behind discount and premium. So you always want to look at structure. So for instance, if this is your 4-hour structure over here, you first want to see them come into the discount range, meaning for instance over here also you would see break of structure. So meaning even this zone over here might hold. So even if this happens, that could potentially be there because then you're following a rule based on your premium and discount. So quick question. What I explained so far today now on the quarterly theory, premium and discount. And what's the other thing we discussed? And just basically the role of the market maker more basically in detail. Just a quick one. Did it make sense to you guys? Did it make sense to you guys? So a good example why I took oil is because you would see over here, we had a supply zone. Okay, awesome, awesome. So I'm gonna flip to a 15-minute real quick. So why did I take oil? So initially I wanted to look for buys on oil. So what happened was on Friday, look at the time, 6:30, not in my rules. So not in my rules, so I didn't take this buy. And as you can see, price then formed a lower low. Now that lower low was obviously a break of structure, right? Internal break of structure. So seeing that price has left this high, what happens now is here is your, as you can see, I was in a premium zone, and that's why I basically took the sell on oil. And now based on now just looking at this internal structure, you can see now price is now back into a discounted range. So for instance, one of two things will now happen. My fib on here, you can see 705 with the order block. So one of two things can now happen. Either this zone will hold, or more or less this zone over here is going to hold. Now it all becomes a matter of waiting for your entry. But by taking it further, for instance, just by looking at this zone over here from this high to this low, you can still see that you're now in a discount. So from there, you can start potentially looking for price to start making higher highs. So I will start looking for a reversal on this in New York session. So looking at the time, we're currently at this level. So just, I was talking about time and price. Time is not adding up right now, so I wouldn't be looking for buys at this level. However, when price can come to this level over here, I will potentially start looking for my buys. And one thing to consider over here as well is just be mindful that this is our Asian low over here. So also for price to potentially slightly sweep below it and then come hold is not unlikely either. So just something to be mindful of as well. But let's take it a bit further real quick before we end the session. Let me show you guys how I break down the market using multi-time frame analysis. So first things first is I want a blank chart and I flip to my weekly. So first things first, let me just clean all of this. What do we see? We can see clearly that price is on a downtrend. We can't deny that. We can see literally ever since, yes, see, since 1971, market has been bearish on GU. Now, for instance, one thing that stands out to me is this low over here, which has been swept. And if you go further into it, you would see that price didn't close below this level, right? So that is obviously sell side liquidity grab. So SSL. Now we can see obviously sell side liquidity being grabbed. Now internally as well, we can see that we are bearish. Now, once again, just looking at structure, I mean, if you look at when price was here, that was back in 2017. Price formed a lower low. This is the new high. Price formed a new low. This was the new high. Lower low. This is the new high. So this means right now at this moment, all I have to focus on is my external high over here and my external low over here. You see now automatically how high I have tracked the market by eliminating everything else and only focusing now on this over here. Now, how do I know if I can start selling GU? Let's see if we're on a premium. So we can see now we're in a premium zone. So sales are definitely on the table. Now from there, we have to look at breaks of structure. So for instance, we can see internally. Now, obviously, if you go to a daily time frame, it will be different. This is comes with experience. So there's multiple breaks of structure over here. Here is loss consolidation, break below. So the supply zone up here. And they also have a weekly supply zone over here. Then you can see price has stepped into the supply zone over here and respected it. Now with price respecting that zone, that shows a lot to me. So also just with that said, you also want to be looking at your open. So this is last year, and this is the beginning of this year. So now you can see, okay, this is all the data from 2022 basically. Price came to that zone last year. So just by looking at this, we can now also see looking at this level from this high, because obviously we had a break of structure over here, indicating that we are bullish internally, but long term we are bearish. So with that said, high to this low, we're in a premium, so we still want to be looking for sells technically. So only when we come below this level, we want to be looking for buys. So as you can see over here, this is a potential demand zone over here. So just by doing that, now you can see you've tracked the market into this little tight range. Instead of looking at all of this over here, all you now have to focus on basically is the structure. It's the structure basically over here between the supply zone and this demand zone. Then what I then do is I then flip to my daily just to go refine these zones a bit more. So I actually made a small mistake there. Sorry. I was going to say, let's just close that door there. So daily and hours. So from there, go to the daily. As you can see now from there, we can now refine this level to a much tighter zone. So instead of looking at all of this, now I know that this is my supply zone, much tighter range. Looking at this demand zone over here, I can refine this much tighter range. Then just now by looking at this here basically, so we can obviously see this is where price tapped into it and this is where we respected. And then this is more or less where price started leaving new supply zones. Just want to mark that out. So you can't see it clearly on the daily. Like I said, it comes with experience. This wick over here is your next supply zone. And then just basically looking at just basically looking at this once again, we can see that, okay, so this is our supply over here internally. Price then flipped bullish at this level. So the next point of interest would be this demand over here. This demand over here. So this is all zones you just want to look at. And once again, we can see we have that nice little liquidity buildup over here. Oh man. Here's that liquidity buildup, basically all of this over here. So now that you have your zones marked out on your bigger time frames, now it's a matter of looking at where you are in the year. So once again, we discussed this many times. This is where the year opened. We can see that price consolidated at the beginning of the year, accumulation, manipulation, here's our distribution. So with that said, knowing that I'm in the distribution phase, I will be bullish on the pair from this level. And why is that? Because now I have a swing low and a swing high at this level, internal structure, and I can see below that, this is the demand zone, which price has left. So when price comes back below these levels, I will start looking for a buy. This is why I also said last week, I'm not looking to sell GU right now until we basically get into other forms of supply. Like for instance, this wick over here will also indicate a supply zone. Now with that said, now we have this marked out. We flip to our 4-hour chart, for instance. And here we can see here's an unmitigated supply. Here's an unmitigated supply. And looking at the year, for instance, here's our yearly data. This is the beginning of the year accumulation, manipulation, and here's our distribution. And as you can see, this wick we also marked out. When GU comes back towards this level, we will start looking for our sales. And then now with this level over here, for instance, obviously we spoke about this as well. We can see that this is 55 pips. Then if we flip to our 50-minute chart from here, I hope I can go back that far. Okay, so I can't go back that far into time. Let's go to the 1 hour. Hopefully we can break it down that far. Okay, that wasn't that far. 30-minute, will that make it? Okay, I think I know what the problem is there. I know what this problem is. It's not visible on the minutes. Okay, still too far. Okay, so then in the case like this, very simple. So you can clearly see that this is when this kind of took price out. So here's the supply zone. And then once again, here's your supply zone. So now you see, instead of having that entire zone as your potential zone to sell from, now you have a zone to look for reaction that is only 9.1 pips. And if price does this, for instance, and it doesn't give you change of character and just continues, it's fine. This, all you do with this is you eliminate it. It's been mitigated, didn't hold. Then only when price, for instance, does something like this, from a higher high, reject fair value gap, for instance, now that can hold, because now, for instance, now this zone over here also becomes only 14 pips. So do you see there, just by Vince, any supply and demand zone that is unmitigated is valid. The moment a supply and demand zone has been mitigated, it is no longer valid. Don't ever trade from a zone that's been mitigated before. You will get hurt and burned. Yeah, so it is 2 o'clock now, guys. Like I said, also, there is someone waiting for me. So I unfortunately have to cut the session here. But before we go, any questions from your side in regards to this? Any questions from your side? Okay, awesome. Okay, awesome. Cool. So yeah, that also guys, remember, like I said, if you guys need mentorship, I have a program you guys can message me on. And also any questions you guys might have specifically, do let me know. I make content. So if there's anything I cover that and I need content and the question is something I can use, I'll put it out for free, obviously, you know. So you guys have contact with me, feel free to message me and stuff like that. I'm not gonna gatekeep anything. And like I said in the end, I love speaking to you guys. I love seeing that light bulb moment go off. So yeah, any questions you guys have moving forward, feel free to message me. And I will see you guys again on next Monday. We'll be talking about some psychology and something else as well. I'm just gonna see what I can implement there. And also, obviously, based on your questions, I'll see what you guys are struggling with, what we need to cover, and we take it from there, obviously. But yeah, see you guys for New York session, and I will see you guys then.